September 2008, a 158-year-old financial institution collapses overnight. $600 billion evaporates as if someone pulled a plug beneath the global economy. Retirement accounts vanish. Jobs disappear by the millions. But here's the part almost no one realizes. The spark that ignited the greatest financial catastrophe of our century began with a lie so simple it could fit on a roadside billboard. Why rent when you can own? Roll the upbeat music. It's 2002. America is still nursing a hangover from the dot-com crash. The shock of 9/11 has rattled the economy, and Wall Street is skittish. But the Federal Reserve has a remedy: slash interest rates to near zero. Suddenly money becomes cheap, borrowing effortless, and a national obsession is born. No longer baseball, but buying a house. Congratulations, you're approved for $500,000. But we only make $40,000 a year. Not a problem. Adjustable rate, balloon payment, NINJA loan. What's a NINJA loan? No income, no job, no assets, no problem. In the early 2000s, homeownership wasn't just shelter. It was a cultural symbol: stability, status, suburban bliss. Every billboard, seminar, and mortgage ad shouted the same gospel. Why rent when you can own? Banks agreed, enthusiastically. They handed out loans like game show prizes. Enter the subprime mortgage, debt designed for people with bad credit, unstable incomes, or only a passing familiarity with money itself. Bad credit? No credit? Living in a van? Sir, you qualify for a luxury condo. Should anyone be worried about repayment? Not really. If the borrower defaulted, banks believed they could simply resell the property at a higher price. That belief, blind, reckless, and historically illiterate, fueled a housing gold rush. Prices rocketed. Neighborhoods doubled, in value in mere months. Baristas with $5 in savings were offered mortgages. Lending standards disintegrated. Down payments became optional. If you had a pulse, you had a mortgage. Consumers bought houses like instant noodles. Lenders printed loans like monopoly money. Brokers earned commissions faster than they could say, bubble. And beneath the granite countertops and staged living rooms lurked a silent question: what could possibly go wrong? By 2005, housing wasn't about stability anymore. It was speculation, flipping properties like lottery tickets. Teachers bought condos at night. Service workers juggled multiple mortgages. A frenzy disguised as prosperity. But beneath the excitement lay rot. Subprime mortgages were toxic. High risk, poorly documented, often barely verified. Wall Street's solution was alchemy: bundle bad loans together and rebrand them as safe. Thus emerged the mortgage-backed security, now with 80% more fiction. How do you make garbage look like gold? Simple. Have ratings agencies label it AAA. Banks paid those same agencies for ratings, creating a conflict of interest so absurd it bordered on parody. It was like paying a food critic who only gets compensated if he calls your raw chicken Michelin-worthy. But the illusion didn't stop there. The financial engineers went further, constructing collateralized debt obligations, CDOs. These were labyrinthine towers of risk, stacked with bad mortgages and sold as sophisticated investments. They were the beating heart of the boom and the core of the coming collapse. A few contrarian investors, armed with skepticism and spreadsheets, saw the truth. They marched into Wall Street's marble towers and proposed something unthinkable. We want to bet against these loans. Wall Street laughed, but they didn't refuse. After all, they smelled steady fees. Thus emerged the credit default swap, insurance against the very investments Wall Street claimed were perfectly safe. The crucial twist? Investors didn't need to own the underlying asset to insure it. It was like buying life insurance on your neighbor's grandmother and quietly hoping she slipped on the stairs. The system transformed into a Jenga tower composed of leverage, lies, and wishful thinking. Each block a risky mortgage, each layer a larger bet stacked upon it, and at the top, bonuses, champagne, and a belief that the music would never stop. Whistleblowers were ignored, regulators slept, executives flush with wealth saw no reason to change course. And then the cracks began. At first a missed payment here, a foreclosure there, empty condos in Nevada. Then the wave. Housing prices fell. Something many believed was impossible. Subprime mortgages imploded, and the securities built from them detonated like financial explosives. Banks holding AAA assets suddenly realized they were sitting on radioactive waste. Losses mounted. Panic spread. Hedge funds hemorrhaged money. And then the shockwave. Lehman Brothers collapses. A 158-year-old icon erased in a single weekend. If Lehman could fall, anyone could. Credit markets froze. Banks refused to lend to anyone. Businesses couldn't make payroll. Families couldn't get mortgages. Retirement accounts evaporated. The job market disintegrated. By late 2008, the global economy entered a full-scale freefall. The crisis went international with brutal speed. Iceland's banking system collapsed. European markets spiraled. Tokyo plunged. São Paulo cratered. The question shifted from who's next to, is the entire system broken? Governments faced an impossible choice. Let everything burn or rescue the arsonists. They chose rescue. The U.S. launched the $700 billion TARP program, effectively cushioning Wall Street with taxpayer money. AIG received a staggering bailout. Automakers were rescued. The Federal Reserve blasted interest rates to zero and fired up quantitative easing, creating money from nothing to stabilize the system. Markets steadied, banks survived, the stock market recovered, but Main Street did not. Millions were unemployed. 4 million homes foreclosed. Trillions in household wealth obliterated. Families who had never missed a payment found themselves underwater, owing more on homes than the homes were worth. Anger erupted. Wall Street bonuses returned. Eviction notices piled up. Inequality surged. In 2011, the rage crystallized in Zuccotti Park under a simple message: we are the 99%. The crisis revealed a brutal truth. Profits are privatized, but losses, those are socialized. The institutions responsible for the collapse were rescued. Their victims were left in breadlines. No major executive went to prison, no handcuffs, no accountability. The system survived, trust did not. A generation grew up knowing a sobering reality. When the powerful gamble and lose, they get bailed out. When you lose, you get destroyed. And the lesson of 2008 is clear. The next crisis will not look like the last. It will appear harmless, profitable, inevitable, until the moment it isn't.